Introduction to be unshakable means to know deep in your heart and mind that you will always be prosperous. It is when you know that whatever happens to the economy or the stock market, you will have financial security. You will be able to provide for your family and also share with others. To be unshakable means to have financial security for the rest of your life. Being unshakable is not just about wealth. It's also a state of mind. Something might make you feel fear or anger, but this feeling does not last. You eventually regain your balance and calmness. You are not quickly affected by what's happening around you. Other people might panic, but you remain confident. You are a leader and not a follower. Do you want to become unshakable? Do you want to achieve financial freedom? This book will ultimately teach you how to become a good investor. You might not have any idea about investing, or you might just be dreaming of becoming one. Maybe you are intimidated by complex terms, or you are afraid of the news you hear about the stock market. But this book will make it easy for you. The first advice that Tony Robbins shared is to control what you can control. Investing might be a scary topic at first, but you will learn specific strategies that will help you become a good investor. Over the years, Tony Robbins has interviewed 50 successful investors like Warren Buffett, Ray Dalio, and Jack Bogle. They shared their secrets of how to become truly unshakable in the world of investing. These secrets will now be revealed one by one. The power of compounding there is a basic concept, a powerful strategy that anyone can apply. That is compounding. Through it, you can turn your small savings into thousands or millions of dollars. You can start by saving a portion of your monthly salary. You can invest that money in index funds. Let's say your rate of return is 10%. Every year, your money would increase by 10%. You should be consistent and add to your investment regularly. Never take out your money and let it compound over the years. Let's take the example of Joe and Bob. Both men invest $300 a month. Joe began investing when he was 19 years old. Every year, he was able to put in $3,600. Joe did this consistently for 8 years. Then, when he was 27, he stopped adding money to the pot. In total, his investment is $28,800. Joe's interest rate is 10% a year. For example, in his first year, he puts in $3,600. Add to that the 10%, and his money becomes $3,960. In his second year, he adds another $3,600. $3,960 plus $3,600 is $7,560. On top of that is the 10% interest. So Joe already has $8,316 in his second year. Although Joe stopped adding $3,600 every year when he was 27 years old, by the time he was 65, his wealth had grown to $1, 863, 287. Now let us compare this with Bob. Bob also invested $300 a month, but he only started when he was 27. He continued doing this every year until he was 65. That is a total of 39 years. But Bob's total earnings is at $1, 589, 733. Let's make this clear. Joe only invested $3,600 a year for 8 years, while Bob did it for 39 years. Still, Joe is $275, 554 richer. See, there is a clear advantage in investing early. Joe just let his money compound over the next decades, although he did not add any more to it. If he kept adding $3,600 every year like Bob until he was 65, Joe would have $3,453,020. He would have $1.86 million more just because he began investing 8 years earlier. That is the power of compounding. Over time, it can turn your humble savings into a huge fortune. You might have heard of compounding before. It is a wealth-building machine that investment gurus like Warren Buffett often talked about. But not many people try to apply it. They still believe that if they earn more, they can achieve financial security. However, many movie stars, athletes, musicians earned millions in their careers, yet they ended up bankrupt. The only sure path to riches is to save your money and invest it. Let it compound over the years. That is how you earn while you sleep. That is how you stop being a slave to money. That is how you become financially free. The wolves of Wall Street, many people think that investing in mutual funds is safe. The advantage is that you do not need to pick individual stocks. Mutual funds reduce risk by providing you with a diverse portfolio. But how do you choose the right mutual fund? In America alone, there are 9,500 different mutual funds. Can you guess why so many companies want to offer them? You got it. Mutual funds earn them plenty of fees. Mutual funds are actively managed funds. The fund manager trades often to beat the market. They try to predict which companies will perform well in the weeks or months to come. But these financial experts are no better than predicting the future than you and I. When fund managers trade stocks, they are vulnerable to making mistakes. They do not only have to decide which stocks to buy or sell, they also have to decide when to buy or sell them. On top of this, all this trading in and out is expensive. The brokerage firm charges a commission for every transaction. Actively managed funds are like playing poker. There are too many chips on the table. There are several probabilities. If the stock goes up after you bought it, you win. But you have to win large enough to cover the transaction costs. Not only that, when your stock goes up and you want to sell it, you need to pay taxes on your profits. Now, let us compare mutual funds to index funds. In index funds, there are no trading in and out of stocks. You simply buy and hold every stock in a list of companies or index, like for example, the S&P 500. It is the list of the biggest stocks in the country. On the top of the S&P 500 are Apple, Microsoft, Amazon, Facebook, and Google. You do not have to choose anymore because they are already the best. Index funds also work on autopilot. They don't trade often, so there are much less transaction costs and tax bills. Plus, they do not have to pay the huge salaries of active fund managers who are prone to making mistakes. You may ask yourself, so what the hell do I get when I invest in an actively managed fund? Well, you have the toxic mix of human error, nasty fees, and high taxes. Warren Buffett is one of the most successful investors in the world. He is the CEO of Berkshire Hathaway. In one kick-ass move, he proved the clear advantage of index funds against actively managed funds. In 2008, Warren had a bet of $1 million with Protege Partners, a firm based in New York. He challenged the firm to pick its top 5 hedge funds, which could beat the S&P 500 index within a decade. The result is that the hedge funds only grew by 21.87%, while the S&P 500 grew by 65.67%. Warren Buffett gave instructions that when he dies, the trust that he left for his wife should only be invested in index funds. You need to think long-term, just like him. Never fall for the schemes of fund managers who charge high fees. The Core 4, in his interviews with 50 successful investors, Tony Robbins found 4 principles that all of them have in common. They apply this Core 4 in their investment decisions. If you want to become good investors like Warren Buffett, Ray Dalio, or Jack Bogle, you need to live by these principles and execute them. The first core principle is don't lose. Great investors do not ask, how can I make more money? Instead, they ask, how can I avoid losing money? It's because it's harder to get back the money you lost. It's harder to get back to where you started. As Warren Buffett said, rule number 1, never lose money. Rule number 2, do not forget rule number 1. Paul Tudor Jones, the investor friend of Tony Robbins, said, defense is 10 times more important than offense. You must always protect the downside. Always remember that the stock market is unpredictable. Financial experts can pretend as much as they want that they know what will happen next. But no one, absolutely no one, can predict the future. You must always be prepared for unexpected events. You must always have a diverse portfolio, so that when some of your assets go down, you will still have others that perform well. You should allocate your assets in such a way that whatever happens to the stock market, you will still be okay. Expect the unexpected. You will learn more about diverse portfolio and asset allocation later. The second core principle is asymmetric risk-reward. It simply means that your rewards should be greater than the risk. It is a common mistake for new investors to think that higher risks mean higher returns. But successful investors say this is terribly wrong. You will only win when there's little risk and maximum rewards. Paul Tudor Jones follows the 5-to-1 rule in investing. If he risks $1, he makes sure that he gets $5 in return. For example, Paul makes 5 investments. Each of them is worth $1 million. He loses in 4 of them and gains 0. Paul already lost $4 million. But if his 5th investment is a success, he will make $5 million. Then he has earned back his money. That is the kind of investment that Paul looks out for. Even if his ratio is 3-to-1, his rewards are still greater than the risk. Not all of us have millions of dollars. So how can you apply the concept of asymmetric risk-reward? You should invest in a time of financial crisis when the biggest stocks are priced very low. In 2008, the stock market crashed. Wall Street went down. Many people lost their homes and their jobs. But for investors like Warren Buffett, it is a time of great opportunity. For example, the price of Citigroup stocks went down from $57 to 97 cents per share. Imagine that. You can own a piece of the company for lesser than $1. But winter is always followed by spring. If you invested during that time, patiently and calmly waited, within 5 months, that 97-cent stock would increase value to $5. That is a 500% return on your investment. The third core principle is tax efficiency. It's not about how much you earn. It's about how much you keep. If you have a high investment return, yet you also have high fees and high taxes, then you are only fooling yourself. You must think about your net income. That's your real money. Let's say that you're a high earner. You pay an ordinary income tax of 50% because of federal and state taxes. If you sell an investment that is with you for less than a year, you will pay the same income tax rate. But if you hold your investment for more than a year, you will only pay 20%, which is the long-term capital tax. Just by being smart and holding your investment longer, you will save 30% on taxes. Now, let's say that you bought a mutual fund that gains 8% a year. After paying the fees, you will only be left with 6%. But since mutual funds trade often, you will be taxed at your ordinary income rate. If you live in California or New York, that will be at 3%. Your annual return would be 3% less. At this rate, your money will double only after 24 years. But we also need to consider inflation, which is at 2%. Now your real return is at 1% a year. At this rate, you will be able to retire when you are 120 years old. The fourth principle is diversification. To put simply, do not put all your eggs in one basket. You can diversify in 4 ways. 1. Invest in different asset classes. Do not put all your money in just stocks or bonds or real estate only. Do not stick to one investment class. 2. Diversify within an asset class. Do not just invest in your favorite stock like Apple or one piece of real estate. 3. Diversify across countries or other currencies. We now live in a global economy, and this is a great opportunity. When a crisis hits your homeland, having foreign investments will give you security. 4. Diversify across time. Keep increasing your investments regularly for months or years to come. When you diversify, you reduce the risk and maximize the rewards. Diversification will protect you in the worst seasons. For example, 2000-2009 is known as the lost decade. The S&P 500 was flat, but smart investors had other bets than US stocks. In a Wall Street Journal article, it was said that if you diversified among a basket of index funds, including bonds, US stocks, foreign stocks, emerging market stocks, and real estate, your investment of $100,000 would grow to $191,859. You still have an average 6.7% annual return during the lost decade. Ray Dalio is a hedge fund manager. He is the founder of the world's largest hedge fund, Bridgewater Associates. His net worth is $20 billion. Ray said, whatever asset class you're going to invest in, there will come a time that you will lose 50% to 70%. Why? It's because financial markets are cyclical. What comes up goes down and vice versa. Ray suggests that you need to have 15 or more unrelated bets. This includes bonds, stocks, real estate, gold, commodities, and other alternatives. By having unrelated investments, you reduce your risk by 80%. You increase your return by 5 times. Slay the bear. It is called a bear market when the prices of stocks decline over a long period of time. It is called a bull market when the prices of securities are expected to rise. Most people are scared of bear markets, but smart investors know that it is the best opportunity for building wealth. It's because during a bear market, everything goes on sale. All the biggest stocks fall on a bear market, but the stock market always rebounds. Great investors know that the bad times never last. They are actually excited when the market crashes. If you wait calmly, the stocks you bought for a very low price will eventually increase in value, and you will earn an incredible amount. Let's see the example of Peter Malloy. He's the co-author of this book and CEO of Creative Planning, which is an independent financial advising firm. Peter looked back in the bear market of 2008 to 2009. On 20th September 2009, the Dow Jones average fell by 777 points. That was the biggest drop in one day. But at Creative Planning, Peter always prepares their clients for bear markets. Here is how they do it. First, they teach their clients to invest their money in a diverse portfolio. That includes different types of assets such as bonds, stocks, real estate, and other investments. Second, Peter makes sure that the client has assets that generate income so they would not be forced to sell during the crisis. That is about 90% of the preparation. The 10% comes from your emotions. You must remain calm while the market is down. No matter how terrible the news is, Peter reminds their clients that every bear market in history eventually turned into a bull market. Think of the calamities of the 20th century. There's the 1918 Spanish flu pandemic, the Great Depression, World War I and II, the Vietnam War, and many economic recessions. So, what happened to the stock market? The Dow Jones average increased from 66 points to 11,497. That is amidst all the chaos of the century. During the 2008 market crash, Peter and his firm continued to invest heavily in stocks on behalf of their clients. They invested the profits from bonds to US stocks, international stocks, and emerging market stocks. They did not bet on individual companies. Instead, they bought index fund, which instantly diversified the client portfolio. What is the result? The S&P 500 index was at its bottom in March 2009. But after 12 months, it was up by 69.5%. In the next 5 years, it further increased to 178%. That's a big win for Peter's clients. Here are more tips for you to prepare for the unexpected and become a smart investor. 1. Put index funds at the core of your portfolio. They give you less fees and taxes while earning more than actively managed funds. Index funds also provide instant diversification. 2. Also include income-generating investments such as bonds, dividend-paying stocks, and REITs or real estate investment trusts. Bonds are loans you make to companies, national or local governments. You earn the annual interest rate on the duration of the loan. Stocks or shares are part ownership of a business. As a shareholder, you will receive dividends from the profit of the company. REITs invest in office or apartment buildings, shopping malls, etc. If the real estate increases in value, you will receive an income from there. Having these kinds of income-generating investments will give you financial security during bear markets. 3. Rebalance your portfolio. It means to bring back your original asset allocation once a year. For example, you started with 60% stocks and 40% bonds. Then the stock market goes down, so your investment becomes 45% stocks and 55% bonds. You should rebalance your stocks by buying stocks and selling bonds. Eventually, the stocks will recover, and you will earn more profit. Conclusion first, you learned about the power of compounding. Start saving a percentage of your salary and invest it. Be consistent and add to your investment every year. Let your interest compound over time. This is how you provide financial security for you and your family. Second, you learned about high fees and taxes. Avoid brokers and actively managed funds. They're just out to get a piece of your hard-earned money. By investing in index funds, you avoid the fees and high taxes on your profit. Third, you learned about the core 4. The first principle is don't lose. The second principle is your rewards must be greater than the risks. The third principle is to be mindful of your taxes. The fourth principle is diversify. They're the proven and effective ways of billionaire investors. So if you follow the core four, you will surely win. Fourth, you learned how to prepare for bear markets. No one can predict the future. You can protect yourself from stock market crash or any crisis by having a diverse portfolio and remaining calm. The bad times never last. If you take advantage of the bear market, the stocks will eventually recover and you will be many times richer. All this information is amazing, isn't it? Smart investing is not as complicated as people may think. Now all you have to do is to apply the things you have learned. What will you do if you become a billionaire investor? You might wonder, what did Warren Buffett do with all his money? He pledged to give away 99% of his wealth to philanthropy. As of 2021, he already donated a total of $32 billion to the Bill and Melinda Gates Foundation. Be a smart investor, earn huge profits, and share it with others. Now that is a great way to live an awesome and meaningful life.